When bombs fall, gold rises. That's what every textbook says. Every financial advisor repeats it. Every crisis proves it, except when it doesn't. In February 2026, the United States and Israel launched coordinated strikes on Iran, killing its supreme leader and triggering the most serious Middle Eastern escalation in decades. Oil surged, markets trembled, and gold, the eternal safe haven, collapsed. Silver fell even harder, crashing over 35% in a single session. Trillions evaporated from precious metals markets in hours. The people who trusted gold to protect them watched their wealth disintegrate while the bombs were still falling. This is the story no one is telling. Because the real danger isn't war. It's what war does to the dollar. Welcome to the financial system. Control the money, control the history. And remember, simple is never easy. To understand why Iran's oil crisis is destroying gold and silver prices, you first have to forget everything you've been told about safe havens. The conventional narrative is simple. Geopolitical chaos equals gold rally. Investors flee risk assets and pile into precious metals. But that story assumes one critical variable remains constant, the dollar. And when the dollar itself becomes the safe haven, gold and silver become victims, not beneficiaries. Here's what actually happened. When the strikes began on February 28, 2026, oil immediately spiked over 13%. The Strait of Hormuz, the narrow choke point through which 20% of the world's oil flows, effectively shut down. Tankers refused to transit. Within days, Brent crude climbed past $82 a barrel. For economies dependent on Middle Eastern oil, this was an immediate inflation shock, and that inflation shock changed everything. Central banks that had been preparing to cut interest rates suddenly reversed course. The Federal Reserve signaled it would hold rates steady for the foreseeable future. Former Treasury Secretary Janet Yellen stated publicly that the Iran situation made the Fed even more reluctant to cut. Higher oil prices feed directly into consumer prices, transportation, manufacturing, food, heating. And when inflation rises, central banks have only one tool: keep interest rates elevated. That decision rippled through every asset class on Earth. Gold is often called an inflation hedge, but that's only half the story. Gold thrives when real interest rates are low or negative, when the return on cash and bonds doesn't keep pace with rising prices. But when central banks respond to inflation by holding rates high, real yields climb. Suddenly, holding dollars or treasury bonds pays a meaningful return. And gold, which pays nothing, loses its appeal. The moment markets realized the Fed would stay hawkish because of oil-driven inflation, gold's rally reversed. Then it collapsed. But there's a second mechanism that hit even harder: the dollar surge. In times of true global crisis, investors don't flee to gold, they flee to the dollar. The United States dollar remains the world's reserve currency. It's the settlement layer for global trade. When the Iran conflict erupted, the dollar index jumped over 1% in a single session, its largest gain since the previous year. That surge made dollar-denominated commodities more expensive for foreign buyers. Gold priced in euros or yen became suddenly costlier, dampening demand from the very investors who might otherwise have been buying. And here lies the cruel paradox. The war that was supposed to send gold soaring instead sent the dollar soaring. And when the dollar rises, gold falls. They move inversely. The dollar is backed by the largest economy on Earth, the deepest bond market, and the most powerful military. In a world where every other currency is vulnerable to regional shocks, the dollar remains the last line of defense. Gold competes with the dollar for safe haven flows, and right now, the dollar is winning. Silver's collapse was even more brutal. Unlike gold, silver is a dual-role metal. About half of its demand comes from industrial applications: electronics, solar panels, medical equipment. When oil prices surge, manufacturing costs rise, supply chains seize up, economic activity contracts. Industrial demand for silver falls precisely when investors might otherwise want it for protection. In the first week of the Iran escalation, silver fell over 13% in just 2 days. It touched $79 per ounce, down from highs above $120 just weeks earlier. Investors weren't buying silver as a hedge, they were selling it to raise cash. That's the third mechanism, liquidity. When markets panic, institutions don't carefully rebalance portfolios. They sell whatever they can. Gold and silver, despite being safe havens in theory, are liquid enough to be sold in a crisis. Hedge funds facing margin calls, pension funds needing to meet redemptions, banks covering short positions, all of them dumped precious metals alongside stocks, bonds, and everything else. This is what happened in 2008, when gold initially fell during the financial crisis before rallying. Crises create forced selling, and gold is not immune. Now, consider the longer-term picture. The Iran conflict hasn't just disrupted oil markets, it has reshaped the global inflation outlook for years. Energy prices drive production costs across every sector. Central banks face a terrible choice: tolerate higher inflation and risk losing credibility, or keep rates elevated and risk recession. Either path is destructive, and neither path is good for gold. If rates stay high, gold suffers from competition with yield-bearing assets. If recession hits, industrial demand for silver collapses. If the dollar stays strong as a global refuge, precious metals remain under pressure. The only scenario where gold truly thrives is one where inflation runs hot while central banks cut rates anyway. A stagflationary spiral where currencies lose purchasing power faster than bonds can compensate. That scenario is possible, but it's not guaranteed. And betting on it while central banks are actively fighting inflation is a dangerous gamble. So what is the lesson here? It is not that gold and silver are worthless. They remain stores of value over generations, protection against the ultimate collapse of fiat systems. But in the short term, in the heat of a crisis, they do not behave the way most people expect. War can strengthen the dollar. Oil shocks can tighten monetary policy. Liquidity crunches can force even safe haven assets into fire sales. The relationship between chaos and gold is far more complex than the simple formula that crisis equals rally. The deeper truth is this: there is no asset that protects you perfectly in every scenario. Gold works until the dollar becomes the refuge. Bonds work until inflation erodes them. Cash works until the system prints more. The only real protection is understanding, knowing how the machinery operates, how central banks respond, how currencies interact, how fear moves markets. Without that knowledge, you are guessing. And guessing, in a world of interconnected crises, is how fortunes are lost. Iran's oil crisis revealed something most investors never wanted to see: that gold and silver can fall precisely when you need them most, not because they've lost their value, but because the system has its own logic, a logic where the dollar remains king. History doesn't repeat, but it rhymes, and this rhyme should sound familiar. Every time we believe one asset will save us, reality reminds us that markets are interconnected and assumptions are fragile. If this gave you a new perspective, hit subscribe. Its financial system and history leaves clues. I show you where the money leads.